Welcome back to the Daily Crypto Roundup. If you opened your portfolio in the last 24 hours and felt your stomach drop, you're not alone. This one hurt. It wasn't a little stutter or a tidy red candle you can scroll past. It was a proper shake, the kind that takes gains you've nursed for weeks and rips them out in an afternoon. I know some of you are listening on the commute home wondering how you went from planning a top-up to staring at liquidation warnings. Others are just trying to keep their head clear and not smash the sell button in a panic. Take a breath. Today we're going to walk through exactly what set this off, why a policy headline about tariffs can slam into crypto like a freight train, how the plumbing of this market turns fear into forced selling, and what the paths into next week realistically look like. And yes, we'll do a quick price check across the top 10 so you've got a clean reference point for the rest of the talk. If this show helps you navigate days like this, do me a favor. Hit follow and drop a 5-star rating on Spotify. It makes a bigger difference than you think and keeps these daily deep dives coming. Here's where we are right now, so we're all looking at the same scoreboard. Bitcoin is $112,449. Ethereum is $3,847. BNB is $1,152. XRP is $2.47. Solana is $184.45. Tron is 31.98 cents. Dogecoin is 19.26 cents. Cardano is 65 cents. Chainlink is $17.89. Avalanche is $22.75. You can already hear the shape of the day in those numbers. Broad pressure, majors and mid-caps moving together. A classic risk-off profile where correlations go to 1 and the market sells first and asks questions later. The numbers aren't abstract, they're the missing holidays. The car repair you just deferred. The DCA plan you worked hard to build suddenly looking like a mistake. So let's treat this with the seriousness it deserves and unpack what actually happened. The spark was a hard policy headline. A new 100% tariff on Chinese technology imports announced from Washington. You don't need a PhD in macroeconomics to see why that would jolt markets. But let's translate it out of political theater and into the mechanics that touch crypto directly. A tariff is a tax on imported goods. Politicians frame it as protection for domestic industry. And sometimes there is a valid national security angle. Think semiconductors, critical software, telecom gear. But tariffs are also a tax on the end product, and often on the whole supply chain. They raise input costs. They inject uncertainty into cross-border logistics, and they signal escalation in an already tense US-China tech relationship. That signal, escalation, travels faster than the actual economics through today's markets because the first thing algorithms and risk managers adjust is exposure, not theory. When the probability of worse before better rises suddenly, the default move is to reduce risk. Crypto sits on the far end of the risk spectrum. It gets sold first. Now layer on the parts of crypto that magnify any shock. Leverage is the big one. A lot of traders weren't just long. They were long on borrowed money. Sometimes 5 times, 10 times, 20 times their collateral. When a tariff headline punches the market in the face and price slides through a support band, those leveraged positions hit margin thresholds and exchanges begin to liquidate them automatically. A liquidation isn't a gentle exit. It's a market order that sells at whatever the market will give. And as liquidations cascade, they push price into the next layer of stops and the next pocket of forced selling. If you've ever watched a 5-minute candle that looks like a cliff, you've seen the chain reaction in real time. That's not whales playing games, that's plumbing. And on days like this, it becomes a waterfall. Another part is the link between crypto and the broader tech complex. Crypto is its own asset class, but it's joined at the hip to tech risk because the buyers overlap and the narratives overlap. When tariffs target Chinese technology and semiconductors, equity investors de-risk across the entire tech stack. Chips, AI, cloud, hardware. Funds that run cross-asset books need to raise cash to meet margin elsewhere, and they sell what's liquid and profitable. Bitcoin is highly liquid. Ethereum is highly liquid. Those are the first taps they turn. You get an echo of the 2020 experience. Except this time, the spark is a trade policy instead of a pandemic press conference. If you felt like everything fell together, Bitcoin, Ethereum, Sol, Majors, mid-caps, that's why. Everyone was selling the same thing for the same reason at the same time. Simplify the book and live to fight another day. Let's talk miners, because tariffs aimed at tech and hardware have a second-order channel into Bitcoin's supply side. A lot of the specialized parts for mining rigs, chips, boards, power systems, are manufactured in or moved through China. Slap a 100% tariff on that flow and the cost base steps up. Miners already run on thin margins and tight energy math. When new rigs cost more and shipping is slower, expansion slows, and stressed operators sell more of their coin to cover near-term costs. We're not talking about a flood that changes the halving math overnight, but on the margin, pun intended, it tips supply into the market on a day that demand is already running for the exits. That's how you get an extra % or two tacked onto a candle that was already ugly. Now, zoom out to the macro lens because the tariff didn't arrive alone. The US dollar took a bid as soon as the headline hit. When the greenback strengthens, anything priced in dollars has to work harder to go up. Risk assets feel heavier. Global buyers have less purchasing power on a currency-adjusted basis. Yields held firm, too. If you're a multi-asset fund and you can park money in treasuries with decent yield while the policy outlook is smoking, that stable carry starts to look like a good place to hide for a week. Crypto can absolutely rally in a strong dollar world. Plenty of cycles prove that. But the mix of an up dollar, solid yields, and a brand new policy shock is the classic recipe for sell first, think later. Okay, so why did the moves feel so one way, so fast? Partly because sentiment was stretched. We came into this week with momentum leaning bullish. People were talking about new highs, about ETF flows re-accelerating, about rotation into alts with beta. Open interest was healthy, funding skewed positive, and a lot of traders had stopped asking what could go wrong and started asking how quickly we hit the next target. That's not a moral failing. That's just how bull legs evolve. But it means the market was sitting in a posture that couldn't absorb a big negative surprise. When the surprise arrived, there wasn't a patient bid underneath. There was a trapdoor. If you're feeling whiplash, that's your body translating market structure. It's the emotional version of a liquidation cascade. Let's stay human for a minute because days like this aren't abstract. If you DCA paycheck by paycheck and watched a month of careful buys go underwater, it stings. If you were up nicely and decided to add a touch of leverage because what's another 5%, you may have been liquidated and you might be angry with yourself. If you're new and this is your first real flush, it can feel like the market is personal. It isn't. You're not cursed, you're not singled out, and you're not alone. Every veteran in this audience has eaten a day like this. The difference between people who survive and people who vanish isn't genius. It's process. Risk small enough that a headline can't end your story. Keep cash for ugly days. Remember that sharp down moves are part of how this asset class breathes. None of that puts the money back today, but it keeps you in the game long enough to see why you started. Let's talk motive because understanding why tariffs at all matters. Governments use tariffs for 3 overlapping reasons: economic leverage, political signaling, and strategic security. The economic argument is that domestic industries struggle to compete with subsidized or lower-cost foreign production, so tariffs level the field. The political signaling is about posture, showing toughness to a base, shaping negotiation dynamics, and framing policy as protection of jobs and innovation. The strategic security angle is newer but real. Critical technologies, chips, AI, telecom are dual use. The same supply chain that builds your phone can build systems that matter for defense. A tariff, especially a large one, is a blunt tool to slow or redirect that flow. None of those motives are crazy in isolation, but markets hear them as louder uncertainty because the tool is blunt. You can negotiate quotas and export controls with nuance. A 100% tariff is a siren. The siren is what markets react to. How does that filter into crypto narratives over the next week? There are 3 clean scenarios and 1 messy hybrid. Scenario 1. The tariff lands, the rhetoric is hot for 48 hours. Then the bureaucracy softens edges with carve-outs and timelines. Markets realize the worst case isn't the base case. Risk switches back on and we grind higher, while everyone who sold too late tries to buy too soon. Scenario 2. Escalation continues. China signals retaliation on US tech or rare earth exports, and we spend a few days in a choppy, heavy range while macro funds trim risk. Crypto correlates with tech and stays heavy. The bid returns only when macro headlines cool. Scenario 3. A surprise positive twist. Legislators or business coalitions pressure for moderation, or there's a hint of a negotiated lane for critical components. That would snap risk sentiment back hard because it would tell the market the policy shock is already being domesticated. The hybrid is more likely. Some carve-outs, some saber rattling, and a news cycle that keeps everyone jumpy but gradually loses heat. In that environment, crypto does what it usually does. Overshoots on fear, then rallies slower than you want, until suddenly it's moved farther than you noticed. We should talk ETFs because a lot of listener questions boil down to one thing. Did the spot Bitcoin ETFs cushion the blow or make it worse? The honest answer is both. They deepen liquidity on normal days and give allocators a clean pipe to buy the asset. But they also add a channel for fast mechanical selling when macro flips. If you saw net outflows on the tape, that's not proof the story is broken. It's proof the vehicle works the way every liquid vehicle works. Flows follow risk appetite. What matters is what happens after the flush. If we see steady inflows resume as volatility cools, that's the institutional version of buy the dip. If we see a few days of flat or slightly negative flows, that just means big money is doing what you and I try to do. Wait for the knife to hit the floor before grabbing it. Either way, the existence of that bid, on average and over time, is net supportive. This market in 2025 is not the market of 2018. The buyers are different. The pipes are different. The reflexes are different. Here's where I give the reminder I give every volatile week. Your security is your responsibility. If you sold today because you wanted to, fine. If you sold because your exchange position auto-closed or your hot wallet got dicey, or you realized your setup wasn't as safe as you thought, that's a fixable problem. Take self-custody seriously. Use a hardware wallet. If you've been meaning to set up a ledger, make this the week you take the step. Getting your coins off exchanges doesn't stop price volatility, but it does stop counterparty surprises on top of market pain. The link is in the description if you need one, and it's the same one I recommend every time because it's simple, battle-tested, and gets the job done. Let's move from the last 24 hours to the next 7 days. What are we actually watching, and what would tell us the worst is over? First, the dollar. If the dollar cools even a little, risk catches its breath. Second, yields. If treasuries drift lower or stabilize, it signals less urgency to hide. Third, ETF flow prints. A couple of quiet days followed by modest net inflows would be a green light that institutional fear is ebbing. Fourth, derivatives cleanup. You want to see open interest down from the highs, funding near flat, and basis normalized. Basically, evidence that the casino chips got swept off the floor. Fifth, real carve-out chatter on the tariff. If there are early signs that critical components and transitional timelines are on the table, the market will systematically reprice the shock from existential to annoying. Sixth, behavior on the chains. Do daily active users, transactions, and developer commits keep doing what they were doing? If they do, price is more likely to rejoin fundamentals than the other way around. I want to make room here for frustration, because that's part of the story. When you work a job, pay bills, plan a life, and then a single policy decision erases a month of careful investing, it can feel rigged. It's okay to feel angry. It's okay to step away for a night. But don't let anger push you into low-quality decisions tomorrow morning. The way you win this game is boring. You size your risks so that bad days don't force your hand. You keep cash so that red days look like sales rather than punishments. And you remember why you own what you own. If your thesis for Bitcoin is that a scarce, permissionless, neutral monetary network is valuable in a world of political money, then today, ugly as it was, reinforced the thesis. If your thesis for Ethereum is that the world is going to tokenize and coordinate on a credibly neutral settlement layer, nothing about a tariff changes that arc. If your Solana thesis is that speed plus a thriving developer culture can create consumer-grade crypto apps, the chain being fast tomorrow matters more than the candle was today. Let's put a bow on the tariff mechanics themselves so you can explain it to your friends who ask why some trade thing nuked your coins. A tariff this large hits confidence, costs, and correlations. Confidence, because it signals a willingness to escalate and inject uncertainty. Costs, because it pushes up input prices for tech hardware, including parts relevant to mining and data centers. Correlations, because cross-asset managers sell the same baskets at the same time to manage risk. Crypto feels it first because it's the cleanest place to cut risk quickly, and because leverage turns an orderly exit into a stampede. That's the whole movie in one paragraph. And like most movies, the third act depends on whether the next headlines are hotter or cooler. If they're cooler, markets will do what they always do: overshoot back the other way, while everyone who panicked tries to rebuild positions. If they're hotter, the path is messier, but not terminal. This isn't a protocol bug or a chain halt. It's a policy wave. Waves recede. Before we close, I'll give you a calm, practical playbook for your next week that doesn't require a crystal ball. 1. Write down your reasons for each core position in one sentence. If you can't do it, you don't own a thesis, you own a ticker. 2. Set alerts at levels where you want to add, not at levels where you want to panic. 3. Right-size any leverage to a number you can literally sleep through. If that number is 0, that's fine. Most long-term winners in this space used little to no leverage. 4. Schedule your check-ins. If watching 5-minute candles is wrecking your mood, commit to a morning and evening review and live your life in between. 5. Talk to someone else in the space. Half of surviving volatility is realizing everyone else is feeling the same thing, and that you're not the only one learning the same lesson again. If this helped, hit follow and leave a 5-star rating so more people can find it when they're searching for answers on days like this. This is not financial advice. It's perspective. And we'll be back tomorrow with whatever the market writes next. We'll see you at the top.